Time for Hot Picks, and we're zeroing in on the retail sector. Our guest has Crocs as his number one selection. He says the valuation on the shares is low, and he does see early signs of a turnaround at Hey Dude. That's a brand Crocs acquired in 2022. We're joined by Zachary Warring, equity research analyst at CFRA. Zachary, thanks very much for giving us the time.
Yeah, thanks for having me.
Just remind us, what is Hey Dude, and why was it a disappointment early on?
Yeah, so Hey Dude is another casual footwear brand that Crocs acquired. It was, originally started in Europe, and they had strong growth early on, but they pushed Hey Dude through their wholesale channels in the U.S. pretty hard in the first year or two, which created growth in that first year or two, but since has seen a significant decline. And we really think that over the last 2 or 3 years, that's kind of bottomed out. We think the first 2 quarters, you're going to see negative growth still, but I think in the second half of the year, you could see Hey Dude create revenue growth.
And broadly, you say that this company has room to grow in the States. What markets are they popular in, or what are their stronger markets?
Yeah, so Crocs is obviously very large in the U.S. and they're growing internationally, and I think they're doing that because of the tariffs in the U.S. But it's got a very low valuation. The management has been very good over the last couple of years of continuing to execute outside of Hey Dude. Obviously, Hey Dude has been the drag. You've seen the valuation go from the high teens forward PE multiple down to, it trades like a department store right now at 7 times forward earnings. So we think valuations at rock bottom. We think they're doing a really good job of growing internationally to kind of insulate themselves from the U.S. tariffs. And we think that's kind of the growth driver moving forward.
Your next idea is Abercrombie A&F. What does this stock have going for it?
Yeah, so Abercrombie's done really well over the last 3 years. You've seen double-digit growth from the actual Abercrombie brand. They have Hollister as well as their second brand. And Abercrombie has grown significantly over the last 2 years. And, their guidance for Abercrombie has come down significantly. And that's just due to the strong growth they've had in previous years. And we think they're kind of handing the baton to Hollister, which is kind of taking the same playbook as Abercrombie. Abercrombie's really doing a good job in marketing. They're using grassroots campaigns and social media, and they're really putting their product out there in a good way. And we think they're doing that now with the Hollister brand, and we think that's how they're going to get their next leg of growth.
And what is their target market? Are they upmarket, for example? Are they a little more expensive than, say, American Eagle?
They are a little more expensive than American Eagle, but they're still not the high end, right? So they still cater to, the young adult up to the millennial. And they're doing a good job of capturing that young adult as well. Obviously, their stock enjoyed a significant rally over the last 2 or 3 years, but it's come down and valuation sits at 10 times forward earnings. So, we really think the name here is a good buying opportunity. We think valuation is another one of those valuations that's kind of rock bottom. It trades almost like a department store, but you're getting much better growth and better margins.
And then finally, Deckers. What's the attraction here?
Yeah, so Deckers has obviously the high growth brand Hoka, and then UGG is their second brand. They're really focusing on those 2 core brands over the last year or two, and kind of gone away from their smaller brands. Those 2 brands have seen significant success, and it's one of the best growers in footwear. Hoka's predicted to grow double digits this fiscal year, with UGG growing mid-single digits, which is really, really strong for the footwear industry. These is the same time that Nike has seen declines and lost a lot of share recently. We think, Deckers has been the beneficiary of that. And once again, this is another company that valuation is really fair at 16 times. It trades at a significant discount to Nike and some of its other peers, Adidas and On Holdings. And we just really like the valuation here for what you're getting in terms of growth.
And so Hoka and UGG are both under the Deckers umbrella?
Yes, that's correct.
And they're relatively upmarket brands?
They are. So the Hoka brand is a very expensive running shoe that's gained a lot of attraction in the U.S. and internationally. And I think that's another leg of growth for them is internationally. They're really pushing, and I think these companies are doing this to kind of insulate themselves from those U.S. tariffs. And we really think it's a great idea. Obviously, it adds to growth, but also, it can help margins if you're not, paying those higher tariff rates in the U.S.
It's interesting. The Hoka shoes that I've seen, they have a massive logo on the side. Apparently, customers want everyone to know that they paid up for a pair of Hokas.
Yeah, and they run upwards of $250 for their newer versions.
And then UGG, those giant winter shoes, do they sell to men as well as women?
They do. They have both. They've gotten more popular in recent years with men, but their target market is still females.
And generally, what do you have to remember if you're investing in a footwear stock? What's the important thing? For example, I guess companies are more and more trying to sell directly to consumers to get information on them and pocket the margins.
Yeah, I think that's kind of all the retail really wants to touch their consumer directly.
Mm-hmm.
You get better data, you get better customer relations, and then it can be a higher margin business, right? But Nike's gone the opposite way. They were going the direct to consumer push for many years,
mm-hmm.
but they've kind of leaned back into the wholesale business. Footwear typically trades at a little bit of a premium in terms of retail. They usually carry a higher multiple.
Mm-hmm.
And I think you're getting a discount with Deckers right now at 16 times. Just a year and a half ago, the company was trading at 25 to 30 times. So it's been almost cut in half in the last 18 months.
Thank you very much, Zachary. Really appreciate it. Yeah. Zachary Warring, equity research analyst at CFRA.